Welcome to Opal STV. I am in Geneva together with Peter Fletcher from the Parley family office. Peter has been investing in hedge funds for many years. Here in this building is a construction, so I want to apologize if you hear some construction and drilling noise in the back. We try to reduce it, but just in case you're wondering, what is this sound? We can't change it, unfortunately. How did you get started in managing money and working in the family office space?
Okay, well, first of all, I do apologize for the noise, but as you know, this is an ex-SBS or Swiss bank building, and I guess like all the private banks in Geneva, they're downsizing, I guess. So anyway, apologize for the noise. I started working here. I moved from Hong Kong to Geneva in the, I guess, sort of mid-90s, and when anyone sells a business, you have a problem because you've got a pile of cash, and hedge funds did achieve what we set out to do because we were 100% alternative. You know, hedge funds, private equity, and some real estate. During the 90s, and for a part of 2000, I guess we did extremely well with hedge funds, but that changed around, I guess, in 2000, we saw more and more money coming in from pension plans, endowments. Everybody wanted to be like Yale and Harvard, and they'd hire consultants, and consultants would go just to the big fund of funds. So we saw ticket sizes going up and up. 100 turned into $1 billion. That was sort of size on hedge funds, and saw a complete change and sort of emanated or stopped in. It started 2007 when we saw a lot of the credit crisis coming, but unfortunately, I had too much faith in a lot of our managers navigating 2008, and we had extreme problems during that year. Given the events of 2008, I think a lot of behavior by managers was just disgusting, for a lack of a better word, and out of that came sort of the rationale for control of your assets. So we had been moving more and more to managed accounts since 2000, and subsequently now it's nearly all we do is managed accounts. Now, before you get the wrong impression, we do have still a hedge fund portfolio, but these are with managers that we've been with a long time, trust them. But right now, also, I think the 2 and 20 model is dead. We don't pay 2 and 20, and nor do a lot of other families that we invest with pay 2 and 20. In addition, we do, I guess, bespoke funds. That is more complex strategies that we couldn't do ourselves. And again, that's another factor. We're trading more internally. With other families, we join together, have significant size, and do our own hedge fund with the manager. In that case, we're in control of the board. We see what's in there, still run the market risks and everything else, but we don't have the risk associated with a hedge fund and deviating from strategy or redeeming somebody out, and you're left with the residual, all the other problems that we're all well aware of.
How did you set up your operation in the family office? For example, how do you monitor the positions and what a manager is doing? Have you ramped up your operational staff here?
Yeah, that's an interesting point, because previously running the family office like a fund of funds, just for one group, where your systems monitoring everything is structured one way, and then setting up all the managed accounts. Now, it's very easy to say, it's very difficult to execute. Fortunately, we've got a good team in Bermuda that has always structured our prime broker relationships accounts exceptionally. Now, on the system side, we work with two groups externally to, first of all, do the reconciliation, the daily NAVs, the sort of accounting and administration side beyond what we use internally. And we have another group also that does more aggregation of all positions, and we utilize more in a what-if scenario. We're able to aggregate and then look, do we have too much exposure to a certain currency, a certain asset class? Now, this has taken a long time and great expense to build up, but we're getting there now, and it's taken us over a year, but we're quite pleased with what's coming out of it at the moment.
Peter, now that you have done all those investments and have the structures and procedures in place, are you now also opening up your family office to outside money, to all the family? Are you moving into the multi-family office model?
No, not really. What we do is we work with other families. And example, we do quite a bit of investing in Canada, have over the years, not because I'm Canadian, it's just because I guess over the last 10, 15 years, we've been investing more and more there, and with the strength of the currency and the returns of our investments have become a very significant portion. We have other families who piggyback on what we do there, and for that we charge a very minimal fee, but that minimal fee covers costs in Canada we have with people, relationships, and other monitoring. So, no, I don't want other clients. I got enough trouble with what I have, let alone taking other clients.
Now, Peter, what's your process in sourcing your managers, and what are you currently looking for?
Sourcing managers is always part of the asset allocation decision. Previously, we were, 100% alternative, using usually hedge fund managers for all our positioning or asset allocation. And that was based on where we considered, performance fee insurance. In other words, not that you wouldn't lose money on the downside, but you'd be stopped out. Well, certainly that game changed in 2008 and others. And now on our asset allocation decision, we look at if we're going to invest in a certain area, asset class, or investment, what's the easiest way to do it? Can we go in directly? There are other ways to do it, whether ETFs. ETFs have their own problems, just like high-frequency trading. That's another whole subject. But once we go through that, can we do it ourselves? We could do it easier with less problem and keep dropping down. And usually we don't have to drop down too far, and usually we don't need a manager. There are specific strategies that we use, that we search for areas that we could not do ourselves. And these are either a lot of legwork, like small cap areas around the world, which we've invested considerably, complex strategies, which we can't do ourselves, and also other areas where we don't have the access, regardless of our size.
Peter, what's the makeup of your manager universe? Are you more focused on smaller guys, on startup managers, or does it not matter and you also invest in the big name?
Well, there are no rules. We've seeded many managers over the years just to implement an asset allocation decision, like commodities. We were very early, oil, energy, and so set up managers per se. I think majority of our managers now I wouldn't call large. I think they're ones that we've been with a long time, many over 10 years. We know them, understand them, know what they do in their position. I think you have to put it in context of what's going on in the world at the moment. No one knows where this world is going economically, financially, fiscally, and we're well aware of the problems. I think right now the major concern is currency. It's not what investment you're in, it's what currency you're in. You do very well in investment and have the wrong currency and be in dire straits at the end. So I think right now we're looking at financial survivability, which is not capital preservation. What bank are you with? Where's your assets held? Is it going to be there tomorrow? I don't think anybody can analyze a bank anymore, given all the derivatives and other issues. And you tie them in with something that really worries me is sort of high-frequency trading, how it just permeates markets, 70, 80% of the volumes there. Exchanges are paying these groups to be there. To me, I see it as a huge risk coming. We see just internally, you put electronic trade through, as soon as you push that button, you're pennied ahead, and you watch the algorithms on some obscure, say, Canadian small cap stock. So it's something I think the regulators have lost control of. And also, we're in a change going forward in, what you should own and how you should own it, and are you ready to hold it for 5 years? I think a lot of the big managers, this is what I'm leading up to, how do you move, 10, 20 billion around these days? Very difficult in markets that you don't know if they exist or not. Most of the volume is not liquidity. And when you try and sell, is that liquidity going to be there? Similar to 2008 when everybody held Deutsche Börse. You knew sooner or later they had to sell, but if there's no buyer, what happens? And we all know what happened.
You said for you 2 and 20 is dead. So what are you doing instead, and what do you negotiate, and how do you negotiate?
Well, coming around to it, it's not really a negotiation. It's hard to make 2% these days. And for years, I've always wondered who came up with this 2 and 20 model. If you go back, it's great for the manager. 20% is just magnificent. I'd do the same thing. But looking at our investments at the moment, we pay, in a lot of cases, below 1%, depending on the strategy. We pay 10% on realized. And the rationale being is a lot of investors realize that family offices like ourselves are real long-term money. And if we put a structure together, we're there for understand it. We can watch the manager. We can come help them out because realizing that, we all travel a lot in our business around the world. We no great intellect on ourselves, but we talk to the smartest men and women. You got a feel for what's going on. Obviously, 2008, some of the best managers didn't really see what's going on. And again, I come back, never again. But we have no problem with other families getting a lot less than 2 and 20. And if somebody comes in with a 2 and 20 fund, why? Unless they're, I guess if you remember back in, the mid-90s, 96, or around there, 97, I used to say, 96% of hedge funds are crap. And I think right now, these days, 99.8 are crap. So it's not, you can get the same thing elsewhere, be able to get out. And right now, there's a lot of replication strategies we've been looking at. And we've been a couple of times in London just going to these events, and it's amazing the number of people are there. You see a lot of pension plans investing in the hedge funds at the moment and willing to pay 2 and 20, but most of those have an 8% target rate, and it's the only way they're going to get there is juice up their returns. Otherwise, their whole actuarial assumptions are off. But no, I've had no problem getting way below 2 and 20. I wouldn't pay 2 and 20.
You say 99.9% of all hedge fund managers are crap. So how do you find then the gems amongst those? What are you looking for? When is a hedge fund manager investable for you?
Okay, they're crap at 2 and 20. It may be a lot better at a lot less. But, now when you invest in a hedge fund, it's just not the manager. You're stuck with who are you sleeping with? Who's in the fund with you? Are they, do they have the same mindset as yourself? And, do managers, when they raise so much money, start investing in things they shouldn't? And nowadays, again, it just comes back to the asset allocation. Example, we're looking at lending strategies. We have lending strategies now. Again, we've been doing it in Canada and Australia where we have a fund. It's call it a hedge fund, I guess, but it's really the merchant bank in form of a fund. We're looking at Europe. So, we look at the experience of the manager. We've already done our asset allocation, so we're going around, who's the best team? How are they equipped? What do they do? Usually, what do they bring to the table? The greatest thing about setting up managed accounts or doing it is you don't have to read the documentation of a fund. For years, people didn't read them in the 90s. They come and they wonder, Gates, everything else. There were certain lawyers. We wouldn't even invest in the fund if the fund documentation was done by a certain legal group. Just because they did it for the manager. They didn't do it for protect investors' rights. So it's just quite enjoyable, actually, when, fortunately, I don't set up the fund or have to go through all the ISDAs or everything else, but not having to go through funds documents, the articles, and see where you're going to get screwed is just great because you're putting the investment management agreement together with a manager. You have a managed account. You know what's there. You know what they're to do. You can control it. And if it goes off track, then you can follow it. But in a lot of these cases, more and more we're working with the manager by working. Certainly not a partnership. They're getting the performance fees. We're not. But we're saying what we see in the marketplace, what we're worried about. And we do have a global view because, as we travel a lot. We see a lot of smart men and women around the world. We talk to other families. And again, the network with other families is paramount. That's the whole key.
Yeah, you just mentioned you talk with a lot of smart people, you travel the world, you've been doing this for a long time. So from your perspective, where do you see the asset management industry or the hedge fund industry in particular heading?
I never thought hedge funds were an industry, but I guess it is a compensation industry for the managers and returns. Over the years, the number of managers that sat in that seat you're sitting in said, well, I'm going to cap at 200 million. And you see them a few years later, they're a couple of billion. Maybe I got my math wrong or stuff. But all these guys are now billionaires running around. Yeah, it's great business for them. But, again, as the old adage goes, is where's the client's yachts? When you see all these billionaire hedge funds, make no sense to me. But anyway, the model's wrong, and I think the model's changing. The families I deal with, we're going around, and we're building up a lot of infrastructure on our own. If you look at where we used to pay for the 2 and 20, 2 is a big number, right? Take 500 million of our hedge fund assets, whatever, that's, you do the math, that's 10 million. I can hire a lot of people these days, 10 million. And, 20%, I cut that by 3/4 and still have a good return. I just think there's been too much greed in that industry. And I said industry again, maybe I'm wrong on that, but sector, whatever you want to call it. But, investment management, where's it going back? Well, I think it's going back to fundamentals. Because to navigate the next 5-10 years, you're going to have to make decisions. And you're going to have to stick with those decisions in a hugely volatile world. And extreme volatility is sort of the norm out there, I think, coming forward. And so maybe it goes back traditional, buying equities, direct and listed. And those you have to really understand, analyze companies. Now, I don't have to pay 2 and 20 for that. Maybe find some long-only, very good managers, maybe value growth type styles, and I can put an overlay myself. And if I want to lose money, I could do it myself. I'm very good at it and proved that over the years. But are hedge funds going to survive? I guess.
What have you been seeing in the markets recently?
I've been seeing some of what I consider some of the smartest investors in the world shutting down shop. We've been with them a long time. They're not the kings and queens in the universe, but they've done extremely well for us over time and are great thinkers, very thematic in one case, and others, doing a variety of different arbitrage and other strategies where with last year and the volatility, and I think it still has a lot to do, as I mentioned before, with markets are permeated by high-frequency trading, the ramifications of that, the interaction with ETFs, especially levered. I was quite surprised that when you get the caliber of those people exiting the markets, I think you have to be extremely, extremely careful. There's some very large, firms getting larger at the moment. Now, are they going to be able to move around? Is that, their monthly valuation when you get these huge multi-billion-dollar funds, is that a real valuation? Can you sell there? Can you liquidate there? I think we had the same problem in 2007, 1996, 1994. Been there. I'll just be extremely, extremely careful out there and be ready, because a lot of people just don't understand the complexity of markets today and the inner dynamics of this HFT and ETFs.
Why do you think those managers are shutting down?
Can't handle it. Don't understand. It's a different environment. I mean, they put on what they thought was rational, fundamental type trades in one case, and very thematic one, to me, one of the best thinkers out there, and just couldn't justify his 2 and 20. You couldn't take a fee on that. And we didn't mind paying for him. We've had money with him for, maybe 14 years, and since he started, and know and trust him. Not that I wouldn't fire him in a blink if he did something different, but he had some bad years, some very good years, but just recently he just couldn't figure out the market. When someone of that caliber can't figure out the market, then I'd be very, very wary.
Are you still seeding managers these days?
Well, seeding was never a business internally. It was part of our asset allocation decision where we would, example, commodities were very early into commodities and energy, and there weren't any managers back then. So foolishly, I probably should have done it myself, built up my own team, charged 2 and 20, and be retired right now. But no, not in cases, because when you do it, you usually get a carried interest, and you go back, and that carried interest could be very valuable if the fund moves up. But I don't see, I think managers trying to set up today is very, very difficult. You have to go after the institutional money, which means an institutional infrastructure, everything else. And I really don't see a lot of families still allocate because maybe they don't have the size to go around, set up managed accounts. But most of the fund to funds that I know around town here are losing their assets quite dramatically. Private banks are in serious trouble. So I think it's a very difficult game trying to seed a manager. And I always thought it was a difficult business because like private equity, it is private equity. You're sort of stuck with the manager. The way we would do it before was we'd just take the carried interest as long as we were in the fund, but we were able to exit if we wanted to. In other words, if the manager wasn't doing what they were supposed to do, then we would just exit out. But it has been very successful when you see the fees you get from your carried interest and the fees the manager get versus your investment returns on a sizable fund. There's a huge dynamic there. Yeah, I think the seeding business is a very difficult business. We just did it because it fitted our asset allocation, and if we can get an extra return, it just helps our internal IRRs for our investing. Doesn't make any difference in my life, but running it as a business, I think, is extremely difficult and complex because you have to make it work with the manager, and you have to go out and move it. And maybe 10 years ago, maybe it's a good model. I don't see it now, not at all. Over the years, we found, a lot of returns are more leverage beta. And if you really do analysis of the manager, you're much better off just buying an ETF or, doing it yourself in a lot of cases. And right now, there's so many different replication strategies out there where you can get the same returns from a basket of hedge funds without all the hassle and put it together and liquidate daily.
So do you actually use replication strategies yourself?
Yes, we do. Looking quite closely. You have one problem, and that's your counterparty risk in a lot of these. So that's something we try and do if we can through sort of listed futures or other entities. But counterparty risk is another issue these days. So we are looking closely. But remember, too, on that side, you only have to put up a small portion of your capital to get the same coverage and exposure as you do with putting with manager. And also, you're not paying 2 and 20. Although banks are ripping you off in some places, but that's a whole other story.